Thank you, Mr. Chairman, and thank our witnesses for being here today. I appreciated your testimony. I serve on the Financial Services Committee as well, and have enjoyed that conversation and your testimony over the years, as well as our discussion on many financial issues. In a March op-ed in the Financial Times, both of you said that, I quote, to avoid permanent damage from the virus-induced downturn, it is important to ensure that credit is available or otherwise sound borrowers who face a temporary period of low income or revenues, unquote, end quote. I think that my personal opinion is I think this is critical. This is a critical concept for Congress that we must understand. Currently, with the stimulus of the CARES Act and the forbearance banks have been given to customers, we have not seen broad delinquencies and charge-offs yet. However, as this forbearance ends and the depository institutions and more importantly examiners of those institutions get back to business as usual, I'm fearful that we will see a broad markdown of assets on balance sheets and even entire business lines at financial institutions similar to what we did in 08 and 09. I repeatedly called for financial regulators to provide additional forbearance to financial institutions and allow them the needed reserve, accounting, and capital relief necessary to allow them to work with their customers. I've got legislation that I believe accomplishes this goal, and so my questions to you are, do you think that additional forbearance for financial institutions is necessary to allow them the needed time to work with their customers? And if our economy continues to be shut down, are you concerned that the classification of non-performing loans will drastically impact reserve accounts at depository institutions and in turn decrease access to credit, particularly in low and moderate income communities? I'd like an answer from both of you, please. Mr. Bernanke, you want to start first?
Sure. I think forbearance is a bit risky. We saw in the savings and loan crisis, that we need to make sure that banks are properly valuing their assets. But the Fed has been trying to work with the banks. They changed the accounting standard, the CECL accounting standard, to make it they don't have to assess the depth of the recession quite the same way. They changed the supplementary leverage ratio. They're telling the banks to work with the borrowers, as you described. I think we don't want to, it's a really good news that the banking system is in such strong condition, but I think it's important to continue to evaluate them, for example, through the stress tests. And if it becomes necessary for some banks to raise new capital, that was the thing that stopped the crisis in 2009. If it becomes necessary to do that, I hope the Fed and the other bank regulators will enforce that.
Dr. Yellen?
Yeah, well, I agree with my former colleague, my current colleague. I think it's important for the Fed, and the Fed has encouraged banks to lend and changed regulations in ways that make it easier for banks to lend. But it's also very important, in my view, as Ben said, that they have the capital that's necessary to meet the lending needs of the economy. And we've seen from the analysis in the recent stress tests, the pandemic analysis, that about a quarter of the major banks that are subject to that stress test are likely to see capital fall below minimum levels if we have a W-shaped, a second wave of the virus, or if the recovery is very prolonged. And it may prove necessary for the Fed to ask them to raise capital.
Well, you kind of made my case there with your last comment, and I appreciate that. But I'm concerned. Both of you are looking at it from a big bank perspective. There are most of the banks in this country are less than $50 billion in assets. You're looking at credit unions that are small in size. Those are the ones I think that we need to be trying to shore up and give the ability to give forbearance to the customers, because they're the ones that supply the small business loans in this country. And you and I, Dr. Yellen, have had this conversation in committee many times. Without that forbearance, and we saw the lack of it in 08 and 09 and what it did and how devastating it was to the businesses, our local communities, jobs, and the banks and credit unions themselves. So I would appreciate a response to that.
Well, many banks, including community banks, have built some significant capital buffers in the aftermath of the financial crisis, and it's appropriate for them at a time like this to be able to run those buffers down to support the credit needs of their communities. But I would agree with Ben on forbearances. We need to know what's happening in those banks.
Okay, I have one quick question for you. You guys have both indicated how you would like to see the $600 or any other sort of unemployment insurance extended. What do you think is an incentive to get people back to work? You're trying to take care of people unemployed. I'm trying to get them back to work. What do you see as an incentive? What would you support, or what kind of idea would you have to get people back to work? I can tell you the $600 is a detriment for people going back to work.
I'm sympathetic to that, sir. You could lower the $600 so that the replacement ratio is not above 100%, is the concern, and you could provide additional incentives to work. For example, you could have a enhanced employment tax credit, for people who are at work, for example. So, I mean, there are ways to improve that, that ratio so that people have the appropriate incentive to go to work without taking away the necessary support of the unemployed.
I know that the president is very supportive of a payroll tax cut, which to me would be an incentive for people not only to stay employed, it's a 70% pay raise, but also people to go back to work. So appreciate your comments. Thank you. Great to see both of you again. I yield back, Mr. Chairman.
Thank you.